Welcome into EP Wealth's Informed Investor Market Update. I'm Rob Black. Joining me today, Adam Phillips, Managing Director of Investments at EP Wealth. Adam, let's start with a quick year-to-date market update, kind of a report card, if you will. I'll start with the best performers and work down to the losers. I don't want to say the word losers, the underperformers of the year. This is as of February 25. Dow Jones Industrial Average up 2.2%. Interesting. We'll start with that comment. S&P 500 is up 1.7% year to date. The Nasdaq's up 1.1%. The S&P Midcap 400 is down 0.7%. And the Russell 2000 down 2.3% as an index. This is the major indexes that I follow. But I also want to throw in an odd one for you, a little bit of a curveball. Bitcoin down 20% from its inauguration high when Donald Trump was inaugurated. That's a pretty severe pullback. And I'm going to have you comment on what you're seeing year to date, and I'll probably have a follow-up or two.
Yeah, well, look, we've seen quite a reversal here in recent weeks. I think you could look at it on a number of time horizons. You could look at it year to date. You could look at it since the election back in November, since President Trump's inauguration. I think what we're seeing here is a reversal of many of those stocks and investments that were originally perceived as the winners in this new administration and with a Republican sweep. We're seeing some give up there. You mentioned Bitcoin down 20%. Tesla, this is a company that shot up about 100% immediately following the election. We saw Elon Musk was really tied to the hip with then President-elect Trump, jumped 100%. It's since given up almost all of those gains. It's still up a little bit, but it's given up the majority of them. The Magnificent Seven down 10%, so now in correction territory. So we're seeing this now. At the same time, we are seeing some broadening out. This really goes back to one of the themes that we've had just over the last year or so, probably more. And it's something we're always going to be talking about, and that's diversification. Now, it hasn't really worked and followed the script in recent years, but we're seeing it work now. And I think it's really important to just acknowledge that. The rest of the market, we're seeing some broader participation within the US stock market. So of the 11 sectors in the S&P 500, 9 of them are positive, and 9 of them are actually beating that S&P, that overall S&P 500 return for the year. So that says that even though technology and some of those areas that have been the recent winners, and really led by quite a large amount, even though they've given up that leadership, they've passed over that baton. We're seeing things broaden out. I think that's indicative of a healthier market. And really, when we're seeing broader weakness and individuals and investors selling their recent winners, I think that's normal. It should be expected. And so I don't think that we should be surprised right now or really read too much into it, other than this is probably a healthy thing to see after the run that we have experienced over the last couple of years.
You're going to find this funny. I've been doing financial media for many, many, many years, 25 plus years. And in the 1990s, late 1990s, CNBC had a spot on where they called it diversification, where you only wanted to be in tech stocks. Otherwise, you were diversifying your returns. Oddly enough, 2002 came along and kind of evened out all those gains from, the 1990s and dot-com stocks. And I'm not connecting the two in this way, in any way, shape, or form, but I thought you'd get a chuckle out of the word diversification.
Well, it's true. I mean, there are these periods, at least over the short term, when it leads investors to kind of question, is diversification really worth it?
Yeah.
And you can really test yourself, and it challenges your own thinking. And look, we've read all the textbooks, we've studied history, but even when you're living in it, it's very hard to maintain that conviction sometimes. And so right now, we are certainly happy that we've remained diversified. That diversification is not limited to the US either. I should mention that. The last several years, 10 plus years, we've seen the US really lead when it comes to global equity returns. It's this idea of US exceptionalism. Now while we've seen this, we've said, look, it doesn't mean that you want to completely abandon the foreign markets. And that's been hard when we've seen this growth-led performance in the US. It's been really hard to kind of stick to that. And right now, we're happy that we have. Let's just acknowledge that international returns right now. So So since Donald Trump's inauguration just over a month ago, we're seeing the S&P 500 you mentioned. It's up about 1% or so for the year. It's actually down about 1% since President Trump's inauguration just over a month ago. At the same time, we are seeing developed international markets up about 5%, and emerging markets up about 5%. Now, just to go beyond that, what is the area of leadership within international? It's actually China. And so thinking about which areas might actually be the worst performers with this new administration, many people would have thought China would be one of them. That's actually not the case. We're actually seeing that China is doing very, very well. There's the NASDAQ Golden Dragon Index. That is companies that are listed in the US but do a lot of business in China. That's actually
Hmm.
up 12% since President Trump's inauguration. So again, I have a slide that I always go through in the market outlook presentations that I do, and it says that the actual investment performance doesn't necessarily follow the script post-election. And this is one of those cases where what you expect to happen in the markets, i.e., China being an underperformer with the prospects of a trade war and some geopolitical tensions, it's actually not the case. And so that's why you also want to place those bets at the margin and remain diversified, because over the short term, these things can happen.
So what's that index called? The NASDAQ Golden Dragon?
Yep, Golden Dragon Index.
I learn something new every time I talk with you. Never heard of that. Um, so let's stick with this a little bit longer because it feels like a change. Is this a reversal? Is this a 5% correction, a 10% correction? Is this leading to a bear market when the NASDAQ and tech stocks lose their momentum? I don't know if that's a question. It's kind of open-ended to see where you go with it.
Well, look, I mean, a 5% drawdown is common, right?
Mhm.
That's nothing to get too concerned about. Even a 10% correction, these things happen. And it doesn't necessarily mean it's going to turn into something more sinister. The corrections are very, very normal in the course of a normal bull market. And so we should expect it. We haven't really seen one the last couple of years because the market's really been trading in a straight line, or certainly what's felt like one. We've seen back-to-back years of about 25% returns on the S&P 500 index. And so a little bit of a give up here, I think should be expected, at least over the short term. Where this goes ultimately is going to depend on a few things. I think we're having this at an interesting time. Actually, NVIDIA reports earnings tomorrow. We're recording this on Tuesday. They report on Wednesday, tomorrow after the close. And so we'll see what happens. I mentioned NVIDIA because it is one of the largest companies in the index. So it does have a large contribution and influence on the day-to-day returns. Last year, NVIDIA accounted for 20% of the S&P 500 return. So this
Crazy.
thing can really move the needle. And it's been moving it I guess, in the favorable direction of late, but things can change. And so if earnings come out tomorrow and they disappoint, this could actually just add to this selling pressure in the market, because one of the main themes, one of the catalysts is being challenged in that scenario. I'll just highlight that while we're talking about NVIDIA, the market, if you look at options pricing, it's pricing in a daily move after earnings of about 8% in one way or another. So the stock is expected to move. This is going to be one of the biggest events to watch this week, and so we will see what happens there. But just if we take a step back from NVIDIA, focus on the rest of the market, we're focused on earnings, right? We're focused on a lot of things: inflation, the health of the labor market, certainly trade, and other policy issues in this current environment. But what we're also focused on is earnings growth. We are wrapping up earnings season for the fourth quarter of last year, but we're focused on earnings over the next several quarters. And so far, earnings growth is expected to remain in the double digits throughout 2025. And so that's good. If we start to see either tariff threats become reality or the economy start to pull back in a severe way, that translates to lowered earnings projections for the rest of the year. That's what could cause that additional selling pressure. So these are the things that we're watching for right now. We're really just looking at this and saying, hey, It's not the entire market that's selling off. There are areas that are actually responding well. And I mentioned that still most of the companies are doing, or excuse me, most of the sectors in the market are doing well so far this year. So for now, we're looking at this as more of a healthy rotation, a healthy pause, if you will, in the market. But we'll be watching to see if this turns is likely to turn into something more sinister.
Okay, let's go back to an investment theme. The first 100 days of a new administration, Donald Trump's honeymoon period. I think if I could sum this up quickly, the first half of the year, I was kind of expecting to see tariffs play out in the market. And the second half of the year, I was expecting to see tax cuts maybe come in if they can find it in the budget, and enough Republicans sign off on it. So the back half of this year was looking to be better because the tax cuts, whereas the first half looked to be slowing down the economy due to tariffs. What are you making of what I just said? And what are you making of the Trump administration's honeymoon period? Because it's about 30 days in so far out of the first 100.
Historically, what you see is there's a little bit more of a grace period or honeymoon period that the investors want to give the incoming administration some rope, and they're focusing more on the positives that are likely to come with the new administration and the policies they bring. Here, we're seeing that honeymoon has come to an end a little bit more quickly than it has in the
Hmm.
past. And you could chalk that up to a few things, but obviously, President Trump has hit the ground running and made a number of major announcements. Some of these are not actual changes yet, or are not fully defined. Look, tariffs so far are still threats, and we expect them to be more a negotiating tool than anything else. But the prospect of them certainly is high on the minds of investors right now, and this is all happening at a time when we're seeing the economy slow down a little bit. Just a couple weeks ago, we got the retail sales figure. It showed that consumer spending was slowing down quite a bit. It was negative month over month, really across all the different measures that they look at it at. We're also seeing at the same time that inflationary pressures are still around. This is not President Trump's fault, and I'm not going to suggest that it was President Biden's either. But I will say that this predates Trump 2.0. And so this is just something that's been lingering. We've actually seen core CPI, so core inflation, meaning if you exclude the impact of food and energy prices, core inflation has remained above 3% for 46 consecutive months.
Wow.
And so that tells you that we've seen price levels, the rate of price growth come down, but it's a far cry from that 2% target. And it's really remained stubborn in this 3% or so range. And so you have stubborn inflation, and you have what appears to be signs of a slowing economy. I'm not going to say one that's going into recession, but a slowing economy. And that brings into play this idea of stagflation, which is a stagnating economy and inflationary pressures. It's a topic that we brought up, I think, about a month ago or so, and we're starting to hear a lot about it. I think this is really important because as you're thinking about all this going on, this is all happening before we even get into tariffs and other types of policy changes that the Trump administration might make. Tariffs, it could be an additional growth shock. It could be an additional inflationary shock. And so that is what investors are really looking at right now. Sure, there's the idea that potential fiscal policies might provide a little bit of a boost down the road. But so far, that's not likely to occur overnight. And so right now, I think investors are focused on what's right in front of them, and that's tariffs and more of the other headline risks that are out there, like Nvidia's earnings and other market events going on.
Yeah. The idea of stagflation is kind of new to a lot of people. Most of us know what inflation is. And I was at a grocery store this week and $10 for a dozen eggs. And later on, I looked up on Google searches. People are actually starting to look to buy hens, Adam. I find that not hilarious because it takes a lot of work and in a lot of places you can't even legally have them. But people are starting to think about how to beat inflation. I know that's not stagflation, but
Yeah, well, that's interesting. We have a new puppy in the house. I think we're going to stop there. We don't need a hen running around either.
yes, sir. On that one, I think that's a lot of work. Okay, so let's move on to consumer confidence because this I think all of these ideas, stock markets at highs, stock markets pulling back, it affects confidence. Um, what does the consumer confidence reading tell you that we recently saw, I believe, on Tuesday of this week? Um, to me, it was a pretty big headline, but I don't know what it means when it comes to investing.
Yeah, well, look, we're always focused on this. We did get it this morning, and it was the lowest reading in 4 years, and we're seeing it's being driven by these fears of uncertainty around tariffs, and it's also fears about going forward, what financial conditions might look like. A lot of the questions that are within the consumer confidence survey are really centered on employment. And so there's questions in there, are jobs plentiful? Do you expect them to remain plentiful down the road? And a lot of these were pointing to expectations for a softer job market down the road. And so that's really feeding into less favorable confidence going forward. Now, this is what we refer to as soft data. And right, these surveys are really important. They tell you what the mindset of the consumer is right now, which is really important because we're a consumption-driven economy. Now, what we're going to focus on is that hard data. What is the data actually telling us? Consumers might not feel too great about the current environment or conditions in the future. But is that actually impacting their activity? So we're focusing on earnings right now from companies that rely on consumer spending and listening to what management is saying about their buying patterns, about their behavior. We're looking at things like retail sales to see if this drop in confidence is actually translating to changes in behavior that could actually impact the economy. So that's how we view them is really it's just one resource for us that we can use as a guide. I don't think it's the only thing to rely on, but it's certainly when you see a drop like this, it's not something that you can ignore. And so we're going to look for some signs of flow through to other areas of the market and data.
I don't know if you have a hard scientific answer for this, but don't you think a little bit of consumer confidence in the short term is maybe focusing in on Doge and Elon Musk cutting federal jobs and people like Mark Zuckerberg at Meta saying, we're going to get rid of the low performers or the underperformers? Is a little bit of it headline driven? Because I guess what it comes down to, Adam, is that I'm implying that I think the economy is softening on jobs because of what I'm seeing in the news, but I feel pretty good about where I'm at with EP Wealth. So I'm kind of projecting a big psychology term, right?
Yeah.
Is there any of that this could be short term and just turn around next month?
For sure. Yeah, absolutely. I mean, these and look, there's also you can I always say look underneath the hood. I'm going to catch myself now. You can look at this data in different ways, and so there are actually screens that you can do to see when people say what their party affiliation is. You can actually see very different views based on
Interesting.
party affiliation, right? And so, give you another example. Last week we saw the consumer sentiment data. So that's the University of Michigan. It's very similar to consumer confidence, but it's asking slightly different questions. And one of those questions was around inflation expectations, and we saw that inflation expectations are now the highest over the long term, meaning 5 to 10 years. In this case, the highest in since 1995. So the highest in 30 years. I think the expectation is for inflation to average about 3.5% over the next 5 to 10 years.
Hmm.
That's a big number. But if you look at the data in a different way, you'll actually see that those who identify and are part of the Republican Party affiliated with the Republican Party, they expect inflation to be relatively flat and low. Those on the Democratic side expect inflation to run away from us. So I think that also changes the lens with which we view this data and which those who are being surveyed are likely to respond. So I think maybe it's another way to say it is you need to take this with a little bit of a grain of salt because yeah, it can hop around from month to month.
Good, good. That gives me some confidence. And I want to thank you for the conversational talk on finances today and money in the markets and where we're headed and where we're not going. It's Adam Phillips, Managing Director of Investments at EP Wealth. I'm Rob Black for EP Wealth's Informed Investor Market Update. Good day.